Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com. Today I have George Arison of shift.com coming to us from Palo Alto. How's it going, George?
Good. How are you?
Very good, very good. Lockdown, shelter in place, treating you okay? You're hanging in there?
Yeah, I've not left the house except for twice since the start. Actually, a week before it started. But we did have to go and get our kids shots because they had their first flu shot before the lockdowns, and then the second one had to be done like 30 days later. So we debated, and actually there's a story in the Times today that people are not doing shots on kids, which is really bad news. But no, we braved it, and so we show up we have two kids that are 7 months old right now, and so we show up at the clinic with like masks, a plastic thing covering our face. Our kids are like laughing to death, looking at us. But we survived. So that's my crazy lockdown experience so far.
You got the shots. Good. Awesome. Well, let's just get to business. What is shift.com?
Shift is a way to buy and sell a car. So if you have a car to sell, you go to shift.com and submit your car information, and we'll give you a quote on that car. If you want us to buy that car from you, you just let us know, and we come and pick it up from you, wire you the money, and you never see it again. And then on the kind of buying the car side, if you want to buy a car, you go to shift.com, find the car you want, and then you can either buy the car right there online and have it be shipped to you, or, which is what most customers choose to do, you can have the car be brought to you for a test drive. And delivered to your doorstep. We built this obviously way before coronavirus, but in some ways the business was built for an environment like this. So my new kind of favorite term is COVID proof, like our business is COVID proof. And so, yeah, we are still in operation and helping people buy cars today if they want to.
It's interesting how some businesses are oddly benefiting from this. I just did a podcast with an online tutoring business, and she said her business has shot up. They started a crowdfunding campaign like in February. March, COVID happens, and their business shot up 800%. Like, you couldn't time that any better, right?
Yeah. So, yep, totally. It's we haven't shot up in that sense yet. And I think, look, all car sales are down, except that everybody else's car sales are down like 80%. Ours are down 30%. So, like yesterday I was talking to somebody like, great job, you're only down 30%, right? Like it's still tough. And it was really bad in the beginning of March, because I think when this first happened, people were really terrified, and the idea of buying a large purchase was not at all like top of mind for anybody. Everyone's kind of like, I gotta buy myself a lot of toilet paper type of thing. But I think as things have calmed down, people have been more willing to buy. I also think like we started to do some marketing to let people know that we actually open, because with so many car dealerships closed, people think like, oh, I can't buy it all. So that's been helpful. And then an interesting thing that we're starting to notice is a lot of people are buying their first car ever. We have a bunch of people who are like city residents who never owned a vehicle, but are now like, I'm not getting to public transportation and Uber and Lyft for a long time. I need a vehicle. And so people are starting to buy because they like expect that when things reopen up, I got to get from point A to point B, and I'm going to have no way to do it, which is kind of a really important point, because unfortunately, as data is coming out of New York, like public transport and subway were a huge spreader of the virus. And so I think we're going to see a huge drop in usage of public transportation and a huge increase in car ownership as a result of that.
That's interesting. Are you seeing a lot of new sellers emerge? Like, hey, I've got to cut my costs. I'm selling this car to you.
Yeah, it was really sad. I mean, it was like so sad that you almost wanted to cry when this would happen. Like right as the virus kind of hit, buyers kind of were much slower, right, for reasons we just spoke about. But we had crazy growth in a number of people trying to sell their vehicle. And, our quotes asked, submissions from customers like jumped almost like 4x in the very early days of COVID. Now that's kind of tapered off a little bit, but still much higher than normal. The problem is that it's very hard to buy cars right now. So we're actually being really careful with the offers that we make to customers because no one knows what pricing is going to be in the future. And so we buy the car, and that's a very risky proposition if you can't predict pricing. And so especially for the cars that are on the newer side, like 2019, 18, 17 models, actually not making offers at all right now because we just don't feel comfortable with pricing those vehicles today. And so it's tough because we want to be able to acquire inventory from people and want to be able to help them if they need to sell a car. And we are making some offers, but in a very limited way. Now, a lot of players in the market, like our analog company, Carvana, which is a public company, actually has stopped acquisitions completely. CarMax obviously is completely shut down in California, so they're not buying anything either. And so it's a tough market right now to be able to sell a vehicle, much easier to buy a vehicle.
I mean, at some point, not to be unscrupulous about it, but at some point, if you could make a incredible low ball offer or buy inventory at incredible deals, and the market starts to
of course, you could do that. So we're trying to not do that, and what we're actually offering customers instead is a consignment offer. So we have a product that we call buyout with an upside, where we offer you a less amount of money front out than we would normally prefer to pay you, and then we ask you to take the risk with us. And then when the car sells, we'll give you some portion of the upside that we earn above that. So say, in an ideal world, we pay you $15,000 for this car and sell it for, say, $17,000, but we don't feel comfortable doing that today. And so we might offer you $11,000, still aim to sell it for 17, but then we'd split the remainder $6,000 in between you and us. And so that way you get to kind of potentially earn more. And, we are able to kind of share risk together in terms of what the car can sell for once it sells. And so we're starting to do that a lot more. And we've had consignment for a long time this way, but this particular product in this kind of buyout with an upside went live in April, not really timed to COVID, but in this environment, it's actually quite appealing, I think, to customers.
Yeah, that's interesting. Very cool. And just another question or two on the business. You're actually taking inventory of the cars?
Yes.
So do you have a warehouse, or do you?
Yeah, we have many warehouses across the state of California and in Oregon as well, where we keep cars. And we also recondition all the cars that we sell. Now reconditioning varies based on the car. Like some cars that are newer, we'll recondition more. Cars that are older, we have a concept called a value vehicle. So these are cars that are over 80,000 miles. Obviously, they're priced appropriately as well. But there we'll do less reconditioning because the person buying that kind of car might not care exactly on the kind of every cosmetic appearance piece of it. He or she is just looking for a safe vehicle to drive. And so we have two standards for reconditioning, core and value, but we recondition every car we sell.
Interesting. What was the motivation for starting this? What were you doing before? What's the backstory?
So I was at Google before Shift. Before that, I started a company called Taxi Magic, which invented the use of mobile devices for on-demand services in transportation. This is like way before Uber and Lyft. I'm not a car guy at all. If you ask me things about what's your favorite car, I have no clue. And it's actually Tesla, but I don't actually know why. Right? I can't tell you all the kind of intimate details of cars that a lot of people can. But I really got excited about the opportunity to transform such a big market that had been not touched by digital ever really. Yeah. So when the internet kind of came out and things moved from newspapers and magazines to the internet, that's when Cars.com and AutoTrader developed, and basically were our listing sites for cars. The same way that before that you would list the cars in a book that the newspaper industry would publish or inside the newspapers. So that's like the level of digitalization that had happened in the States, which to me was crazy. And so opportunity was really massive. And I also like the fact that you could build a great company that was big and very successful without having to take a huge portion of the market, right? CarMax, which is by far the biggest player here in used, is 1% of the overall car market if you add up used and new cars together. And Carvana is even less. Now they're trading at a better price, and so they actually worth more than CarMax right now, but are much smaller than CarMax. And so you could build a great massive public company with capturing 0.25% or 0.5% of the market, which is not common for Silicon Valley companies, if you want to be a public company, you have to capture a really big portion of the market in software. And so that was really interesting to me as well. Now, I had no clue how difficult it was going to be because this industry is really complex. Operations is way harder than anything I ever thought would be. I would be like, oh, operations is easy, technology is hard. No, man. Operations is really, really hard. And so I have a totally new appreciation for how complex operations are and all the people like, oh my God, I can't believe United Airlines is an hour late on my flight. I'm like, the fact that they land 70% of their flights on time like is an incredible achievement given how difficult operations are. And so I have a totally new appreciation there, but that's kind of how this business gets done.
Yeah, that makes sense. Did you think about, just doing a better marketplace? I guess why decision to take on the inventory?
Well, we did. The very first models for Shift were kind of the models being in on paper and in PowerPoints, where we would not take in inventory. But as you kind of do this business, you learn that you have no choice. Customers want to get rid of the car and they want money up front and they want it now. And then you need to do reconditioning to have a good experience, and without taking inventory, that's very hard to do. Next to impossible to do, because if you're going to put in the money to recondition a car, that means the customers without a car for 5 or 7 days. Then you let them drive the car while you're trying to sell it. That's a little bit weird because you just put all this recon in. What are you doing? So it's just too complex. And so having kind of control of the car is really, really critical for this to work.
Got it.
And I think also, when you think about successful marketplace businesses today, many of them do have to control the inventory to some extent. Obviously, being Airbnb is exciting and awesome, but there are very few businesses where that actually works. And even in the Airbnb model, people expect you to have much more of a full stack experience than VRBO, for example, which is basically Airbnb is like a newer version of VRBO, right? Where they don't control the seller, the person renting something out as much. And I just think that consumers expect more uniform experience. And so we do believe there is a marketplace opportunity with Shift, medium term here, where letting dealers list with us. And what we've seen happen since COVID is we've had a lot of dealers reaching out to us being like, hey, can I use your technology to list with Shift and sell with you? Because they are trying to figure out how to sell without a customer having to come to store. And we're the only ones that have this kind of local market logistics platform for delivering of a test drive. And so I think a lot of people are really interested in that now. And, it's remarkable that, all these dealers are not able to deliver a test drive today. It's kind of crazy, but it's a huge need. So CarMax has built out an ability to sell online and does have store pickup, but doesn't have the test drive brought to you. And I think that they're going to really suffer from not having that, because any customers are going to be just pleading for the car to be brought to them, right?
Sure.
When behavior changes, it changes usually forever. And so I expect that, people will be doing much less grocery shopping in the store later than they are now. And especially in the next 18 months, even after we open up until there's a vaccine, you're going to try to minimize how much you come into contact with crowds, right? And so I think there's a huge opportunity for the marketplace there, and we are thinking about that. Can we try to in some way both help the industry and help build up business more by listing cars from third party dealers who would then be able to provide a certification and quality check that we need to have a really good product.
Makes sense, yeah. And it seems like, I can't think of the name right now, but I know I've seen other startups sort of try and attack the dealer side of the market, right? And hasn't there been a couple big flameouts there?
There've been a few startups trying to build products for dealerships. There's a company called Moto. There's a company called AutoFi. They are trying to kind of help dealers in the digitalization path. Hey, you can offer financing online. I mean, you can't apply financing online in 90% of the dealerships in the country, if not more. Let alone transact online. You can't even get a loan approved, so to say, or even your information submitted. So the industry is really far back, right? It's not oh my God, your website is old. No, this is we don't have functionality on a website that is kind of completely expected by a consumer.
Sure. Yeah.
And some of it is not people don't want to do this. It's really hard. this is a very complex industry, a lot of players involved. Most dealers sell new cars and used cars. The process of selling a used car is much easier than a new car. New car, you're dealing with OEM, you're dealing with OEM incentives, you're dealing with OEM lending products, right? Like there's a ton of stuff there that is just really complicated. So again, operations is really hard. And so a lot of people come in and like, easy, I'm going to solve it with software. But then once you start, quote unquote, solving it, it becomes a lot more difficult than you think it is. And there's a reason why some of the stuff hasn't moved as fast as it has. And it's been a very humbling experience for me from that perspective.
Well, if you can solve it, like you're saying, it's a big market. Let's talk about fundraising.
Exactly.
I want to get to that. So how much have you guys raised and over how many rounds?
Yeah, we raised over $225 million of equity and another $75 million of debt. We've done Series C and then A through D. So I guess, 5 rounds we consider seed one of the rounds. Now, the market's obviously moved a lot since then. Now, like what we would call, so when I did my first company, the first round was Series A. Then I'm like, okay, as the seed thing happened, I'm thinking that it turns out that should have been a Series C, not a Series A.
Sure.
And so then at Shift, I raised the Series C. On a convertible note. This was, safes were just getting started back then, and I felt more.
This is for Taxi Magic you're talking about?
No, this is for Shift. Like in 2014, we raised a seed round using a convertible note. But now, like when I talk to founders today, like I got the angel round, the pre-seed round, and the seed round. I'm like, oh my god, like it's just kind of crazy. But it just feels like people are moving. Everyone's trying to be later and but there's so much money in the beginning of the process, so they have to invent all these new rounds in the beginning. And so funds that claim to be seed, but I expect you to have $200 million ARR, and you're like, it's $200,000 ARR, and you're like, that's not a seed-based company anymore, right? What are you talking about?
Right. Talk about that first round maybe. Actually, before we get there, with Taxi Magic, did you raise a lot of money for that, and did that have an exit?
Well, I was not doing the raise as our other co-founders were. I was young and didn't know what I was doing back then. But we did raise capital, so we raised about a $2.5 million what we called Series A. Then we made that actually a $5 million Series A. That should have been the seed round, and then we raised another $10 million Series B. The B was really interesting, and we should talk about that. And then after I was no longer there, then we raised another $30 million Series C. And then the company was bought by Verifone eventually. When I left Taxi Magic in 2010, it was by far the number one player in the market. 10-20% of cars booked and taxis booked in most large cities was done on Taxi Magic. We were inside Apple ads, like in newspapers, etc. As a product that they were really pushing. And Uber was just getting started as a black car product, and Lyft didn't exist. It was Zimride as a way to get people to go from cities to colleges and back, sharing a ride. So we were really far ahead of everybody and doing really well when I left. And then we made a bunch of big mistakes. The company did, obviously, which cost me many millions of dollars. We never gave the drivers a phone to use as a product. We were working through the dispatch systems inside the taxi fleets, and that was a big error. And then secondly, we were very much in the kind of SaaS mode, like someone had to pay. So we really wanted the taxi fleet to pay, and we really wanted the consumer to pay for using our service, not just for the booking experience, et cetera. And so I felt like it was a mistake, but we were very much in that mode as a business. We wanted to have revenue, and of course, like what we should have done is focused on growing our user base. Forget about revenue for a little while. And then once you captured enough user base, then you should have gone to revenue. So that would have been a much better approach. But in enterprise, the view always is, okay, if you don't charge somebody something now, that's bad. That was always the view historically. Now, obviously, freemium model has spread into enterprise as well. And so now you see a lot more like use me for free and then you start paying. So that was an error on our part over there, which kind of basically allowed Lyft and Uber to exist. But there at Taxi Magic, we did have a really horrifying experience with capital once. So when we were raising our, what Series B, basically, that round was led by a company named Concur. Now it's part of SAP. And we had just signed a deal with Lehman Brothers, where Lehman Brothers was guaranteeing us $500,000 in revenue a year to help manage their black car business in New York through our software. So same as kind of booking a taxi, but like book a black car to come to you, because in New York you couldn't book a taxi to come to you. And like that was an amazing thing, right? Because like $500,000 for an early stage company like that, great revenue, but also great proof point that this big bank is using us. Now we can go and pitch 10 other banks to do the same thing. And that contract was signed literally like a week or two before Lehman Brothers died or declared bankruptcy. And of course, this term sheet was offered on the assumption that this Lehman Brothers contract was going through. And so then they pulled the term sheet as well because, stocks were collapsing, et cetera, et cetera. So when we only had like a couple months of runway left now, fortunately, we had a co-founder there who was, very successful previously. And so he kind of bridged us until we were able to raise capital in January from the same lead investor, strategic, except at a way less good valuation. So that was a tough experience for us, obviously. And so my learning from that is, as soon as you get a term sheet, you got to push super fast to raise money, as quickly as possible. Close the docs. And so my lawyers hate me usually because I'm like, okay, term sheet signed, like let's turn legal docs around tomorrow. And like the minute feedback comes in, return feedback back within a day. And so they always think I'm crazy, but I have this like kind of mental block on this point
Scar
because
tissue.
I've lived through it. Yeah, exactly.
No, that makes sense. Interesting. Cool. That's I'm sure that story that you just told played out in 100 other variations with other startups during that time. It's like,
well, but yeah, back then, and it's happening now too, right? Like I've talked to a lot of founders, and I think it's really interesting where some VC funds have been very good and have said, you know what, if we have a signed agreement as a term sheet, we're going to fulfill it, we're going to meet it regardless. Or if, we have a handshake, we might still do it as well. And others have pulled capital, and some founders have been very public about that. Told these are really horrible stories. And, I really do respect the VCs who've just said, we have a deal, and we don't back out on a term sheet. And it's not binding, but we still, in a moral sense, do keep our term sheet going thing. Because yes, I totally understandable, right? Like, I know of a case somebody told me about, I don't know the name of the company, but like literally the legal documents were done and the wire was supposed to happen the next day. And that day happened to be the day the stock market fell, the most, like something like 8% or 10%. So the investor did not wire. Now, like that's just horrible, right? Like, come on. And like once the deal is done, you got to do it. And so I'm sure a lot of companies have had a really hard time with that, and it's really tough. So
I can understand that, just to play devil's advocate for the VC, if the economics of the company and the outlook has now changed, I can see why they'd want to perhaps renegotiate the deal. Right?
No, I get that, but I mean, like, look, there is a set of customs to this business, right? In terms of relationships that are not legally written anywhere, but expectations, right? Like it's kind of like, founders stay to the bitter end and don't leave during hard times, and that's all because the $150,000 you're making a year is worth kind of killing yourself to the bitter end, right? It's because you have a moral obligation to your shareholders and your employees and then so forth. And so I think everyone has obligations here that go both sides. And like, look, if a company was like, did a pitch and was in discussions but didn't get a term sheet, totally understandable that deal does not get done. But if there's a term sheet signed, right? Like, and I mean, I remember one of my investors in my series, because I was terrified that something would happen, term sheet won't get moved to conclusion. And I remember one of my investors telling me that the message was, look, in my time that I've been a VC for over 10 years at this point, I mean, this is a long time ago now, we as a firm have only pulled one term sheet in the entire time. And that was because the founder lied to us. He had changed his name and had a criminal record and had been in jail under a different name. And then when we discovered, we decided to pull the term sheet. And even then, it was like a hard decision to do that. And so I think that's a really important kind of code in terms of how VCs behave. And so simply because there's an economic upheaval, you expect them to behave the normal way. Because guess what? Everybody's your friend when times are good. The really good investors are your friends when times are bad. And so I think that's a really important kind of, you get to see who's your true friend and who's not. So.
Let's talk about, we're not going to go into every round that you guys have raised, but maybe let's do a little bit on the seed round, because I'm looking at, again, if PitchBook is accurate, a pretty interesting seed round with about 45 like angels and
I think it was like 80.
Okay.
I think it was like 80 angels, or 60 to 80 angels. Yeah, I mean, look, we I didn't really know much about fundraising, and I think now I'm pretty good at it, and I'm good at selling our story, but I had no idea how to do it. And Joel Washington, who was my co-founder, had been a VC as an associate at a fund, and so he had a little bit of a better sense. And so he's like, "Look, we should just go out and raise a seed round." I'm like, "Okay, well, let's go raise a seed round." So we just started talking to people, and one of our kind of first things in our mind was, okay, how do you prove that people should back you? Is, okay, let's go get backing from everybody that knows us really well, right? And so we're like, okay, every job we've ever held, we want to get at least one person from that job to write a check, right? Mm-hmm. Whether that's like our friend or a business partner, whatever. And so we went out and, like, in every job we ever had, we tried to find one person who could write a check and do it. And we didn't really care how big the check was necessarily. Like, it kind of doesn't matter. Then we're like, okay, of the people we know, who are people who can be value add as we build out as a business? Yeah. Like, who are strong product managers, who are strong BD people, et cetera. Okay, let's go to them and raise money from them. So we kind of, that was like early money that we raised. The first, $900K. Included in that was one large check from a company called AmTrust, which is an insurance company that was in the business of providing warranty products to auto insurance companies and auto companies. And so there was an opportunity there as well. So we kind of raised, that first check into that seed round of like $900,000 from a bunch of different people. And then it kind of ballooned from there, right? Like, super lucky that people were willing to kind of trust us in this very early days when we had, like, I think, experimentally sold 5 cars just to, like, kind of see what it's like to sell a car on Craigslist, but didn't really have any, like, no product, nothing. And so we and then we just continued fundraising. And because what happens is people introduce you to other people and people hear about it around and come to you and whatever. And so we just continued raising, and we ended up raising like almost $4 million in that seed round, which was really awesome. Now, yes, times were good, and team was really strong, because after we raised our first capital, then we added a couple other founders to the team that were very strong founders. And so it kind of just ballooned from there, and it was a really good round. Now, we did something unconventional. We didn't put a cap on the note, and so it was like an uncapped with a steep discount. I don't know if I'd do that again, that way, because I actually think being overvalued is a problem as well that people don't fully appreciate. And so I would probably do that a little differently today, but that was kind of the approach that we took.
Interesting. You mentioned before the call kind of fundraising as a process of discovery. Talk about that a little bit. What do you mean?
Yeah, so I mean, I think a lot of people have this idea, right? And I talked to a lot of young founders, because I was, by the way, very lucky with kind of a lot of old, experienced founders helping me figure out what to do. And I feel like it's important for me to be doing the same thing now for folks. And so, like, okay, I'm going to find this investor and convince them that they should invest in my business. And I'm like, there's no such thing as, like, convince them that they're going to invest in your business. Most VCs in particular, like Series A, Series B VCs, have set of theses that they believe in, right? Like, I believe in investing in these types of companies. Indeed, oftentimes the funds have theses like, okay, I'm a fund focused on consumer, or a fund focused on SaaS, et cetera, et cetera. And it's not that they thought necessarily about the fact that this particular vertical is the one I want to invest in, but this is a thesis I have, and I'm going to look at many verticals to see where that thesis fits in. And so I think what fundraising is for a Series A company is going and talking to a lot of VCs and finding whose thesis align with your thesis, and then who finds your vertical interesting in the thesis that they're working in. And so I think once you do that, and once you have that discovery, then you can have a conversation about, hey, let me convince you why I'm the winner in this space, why we're the best team, why we are going to execute the best, why you should invest in us. But until you kind of find that match, I don't think it makes any sense. And so I'm a really big believer in talking to a broader range of people than people normally would do. And there's a lot of benefits from even investors that you might not raise money from, in terms of getting to know them and then getting to know you. Some of the best investors I've dealt with, Josh Koppelman, Jeff Jordan, Jeff Lewis that used to be at Founders Fund is now at Bedrock Capital. These guys did not invest in Shift, and I kind of, call some of them like the ones that got away. But the feedback that they gave me during the process was really useful feedback in how I managed the business as the time progressed, right? Now, I think in all three of those cases, actually, the thesis is matched, right? There's a lot of reasons that they should have invested, and there's reasons why they shouldn't have invested. And some of the reasons that they gave us actually were, reasons that made our business complicated. For example, hey, this is going to be way more operational than you think. It was one of the feedback points from Josh Koppelman, which we were like, oh no, it's not going to be. Well, turns out it was, and he was right. And I think his point was the operational level of this makes me a little bit nervous. Yes, we could get comfortable with Uber's level of operations, but what you're talking about here is a lot more. And I didn't fully appreciate that when we were getting going, and now I do today. And so I think there's a lot of benefits to getting to know really great investors, even if they don't invest in you, because you will learn a lot from them, both then and later. And so, and they might tell you things that you might not pay attention to, but then over time, it becomes really, really critical. Now that changes, I think, over time, like as you get into the kind of pre-IPO rounds, the many obviously, but like more growth rounds, it's a different story there. But I'm still in the earliest stage. It's pretty limited universe of people that you would be raising from in a Series A, Series B, right? There's only so many funds and so many investors. And I think there's a value to getting to know as many of them as possible. The other thing that I think is really critical here is, a lot of people pay a ton of attention to the name of the fund, or I really want to raise money from Sequoia, right? Or whatever. Honestly, and I was just as fault at that too. I had this chip on my shoulder, whatever. What really matters is who is the individual you're working with. And is that individual going to be with you through hard times and easy times, right? When things are great, everyone's with you. it's when things get really hard that we kind of see who really matters and who's with you. And it's we were really lucky with the Series A investors we end up working with. Emily Melton from what is now Threshold Ventures, used to be DFJ, and Manish Patel from Highland Capital. So these guys have gone.
Say that again. Who is that?
Emily Melton from Threshold and Manish Patel from Highland Capital. Okay. And we've had good times and we've had bad times. And these guys have been with us through, thick and thin, and have been with us the most and in the best way when things have been hard. And I can't just express how, valuable that is. And there are many people we could have raised money from who would not have been like that. And so I just think picking the right person is so critical, and kind of over focusing on the name of the fund or the valuation you're getting is really not the right place to focus on. Find the best partner you can find for your Series A, who you're going to really trust to make your company be successful, and work with that person.
Was that second name Manish Patel, or who was that second?
Correct.
Okay,
Manish Patel. P-A-T-L.
Awesome. Let's talk a little bit about down rounds. You mentioned before the call that you've been through a down round. We've never, believe it or not, in 150 episodes of this podcast talked about down rounds,
because no one's willing to admit that they've done a down round, even though some great companies have done down rounds. I mean, Postmates did a down round. I believe Redfin did a down round. It's totally normal to do down rounds. By the way, stock prices in public markets go up, go down. Stock prices aren't always the same. Why is that wrong for private companies? And then secondly, we did live through a crazy positive economic time for the last 10 years, but capital was just kind of throwing, as if it was water, and that's going to change. And the reality is that, we are entering an environment now where a ton of companies are massively overvalued. I think flat is going to be the new up round, to be honest. And then, it'll be incredible. Look, it'll be incredible if companies are able to do up round. Some companies will, no question, right? Stripe, whatever, but that's not most companies. Most companies are going to have a much harder time, I think, with capital and so forth. Yeah. And so we did do a down round at Shift. I've generally been very open to that.
Which one was it? Can you share?
Series C.
Series C was it down? Okay.
Yeah, we were. I don't ever talk about valuations as numbers. I have a policy to not give numbers, whether they're good or bad. And so, but we had a very high price after the B. There was a little bit of a kind of contraction in economy. Contraction, it didn't fall, but markets were really bad in 2016, 2017 for a while. China had a big economic mess happen, if you remember. And so following that, plus we had a lot of issues with our performance. We didn't quite do as much growth as we had expected. This is kind of when we learned that operations is going to be so hard. And we had, our price was one that we had to kind of grow into. But that's okay. We just better raise enough money to grow into it. And I think we had a high price, but we only raised $50 million. Had we had that price and raised $100 million, it might have been a different story. But coming out of that, we had to raise a round. And then, by the way, we actually had a term sheet for a Series C that was more of a flattish up round. But then Donald Trump got elected, and that really messed that term sheet up because it was a foreign-led term sheet from a foreign investor who was like, wow, like, I'm not sure I want to invest in a U.S. company anymore in light of Donald Trump's election. And so anyway, so that was cool. And we went into, a period where we had like 6 months of runway, and we needed to do whatever it took. And so we ended up having to do a down round. And before that round came together, our board did a lot of work to get the company to a place where we could do a good down round. And one of the pieces of advice that Simon Rothman at Greylock gave me around then is like, get your insiders to commit to a price, and get your insiders to commit to how much money they're going to invest, and try to put that on paper. And that was exactly also the advice that internally on the board, Emily Melton was pushing our board to do, right, in a very like enlightened way. Hey, we got to do this before George goes out to fundraise. And so we agreed to the down round, price as a board internally before we went out, and we had a commitment for capital as well. Like, we're going to do X millions of dollars from the insiders if we can get a lead of Y or another investor of Y. And that really created a really positive leverage in terms of discussions with new investors, because new investors don't like to do down rounds. And here, because like the cap table cleanup had been done internally already, it was much easier for them, because now they're not coming in trying to force something that people are unwilling to accept. Rather, it's like, okay, this is my set of terms based on the terms that you have already said you're willing to accept. So that's like one kind of really critical thing, is like, if you're going to have to do a flat or a down round, try to get your insiders to commit capital, and try to get your insiders to commit, to a set of terms in terms of what they think is right. Obviously, like, it's a little bit of negotiation with yourself, because now you're like admitting that the price has to be cheaper. But, in this environment, I think that's okay.
I was going to ask, how did you know you needed to do a down round? I mean, and did you go out to the market and the market was telling you that, or you just sort of knew?
Yeah, no, we were, because we had been in the market. We had this agreement for funding from somebody, and then that was pulled, and that was already like, basically flattish type of round. So in an environment where that didn't get done, we're coming back 3 months later into the market. It was pretty clear that we would need to do a down round, and you kind of, I think it's hard to decide what the price is, but you kind of have to like figure it out. So the other big thing that's really complicated in down rounds is what's called anti-dilution, where basically existing investors have a preference, which gives them the right that they would get extra shares for their old investment, in order to prevent them from being diluted too much. But obviously the common shareholders, including all the employees, don't have that. And anti-dilution is a very complicated thing. If you talk to lawyers, they'll tell you, look, out of the down rounds I've done, 50% of the time anti-dilution is waived. Obviously existing investors really don't like to do that because it really hurts them. But that's something that people should be aware of and try to negotiate with their existing investors on. Most likely, new investors will insist that anti-dilution be waived. And so that's something to kind of be aware of as well, because new investors will be very much pushing for the team to be protected, which makes sense as well, right? Because they would want the team to be in a good position. Another factor that oftentimes comes into play, and this is one that VCs hate, but for example, it's public that Postmates had to do this, is like, do you change your liquidation preference stack or not? And so in down rounds, sometimes the old liquidation stack is changed, and like, whereas normally liquidation stack might be tied to a specific dollar amount invested. Sometimes in down rounds, they'll say, okay, no, it's going to be tied to the number of shares that you have. So you might have before you might have had $2 per share in liquidation, but now we are raising money at $1. And so your new liquidation preference for your old investments is only going to be $1 as well. That's much harder to do.
Mm-hmm.
But again, there's an example of Postmates public. You can look it up, in kind of stories from TechCrunch and information where they've done that. And again, that is mainly done to kind of keep the team aligned and keep the team in a place where they don't have a huge lick prep sitting on top of that. And so those are the kinds of things you need to be thinking about as you get into a down round, and try to get as much alignment among your existing shareholders on that before you go out. I think the teams usually really get nervous about dilution. My message on that is like, don't worry about that. Yes, it kind of sucks for people who were at your company and then left, because there's nothing you can do with them. But existing employees kind of go forward team, you can take care of the go forward team. And everyone's going to be very aligned that the go forward team should have a lot of ownership. Now, tough for the founder, because the founder is not going to get any kind of big uptick in their ownership compared to what they had before. But quite frankly, most founder ownership is totally artificial, right? Like, is it really that the founder who started the business owns 50% and the first employee owns 1%? Like, that makes no sense, right? Like the order of magnitude difference there is way too big. And so I was like, I didn't take any re-up in our down round. And my view was like, look, my ownership is really artificial. Does it suck that it's going to be diluted? Of course it does. But that's just the reality of what has to happen to make this company be successful. And I still own more than anybody else does, even after the dilution. And so, my incentivization is still very much there. And so, but I think you do need to really focus on taking care of your existing team as much as possible.
This is good advice. If it's a good playbook here, getting your investors to commit to terms and amount they'll invest, asking if they'll waive
anti-dilution
clauses. And if they're not willing to do that, how can you help ease the burden on your employees or make?
Well, you could do a big pool, right? You could do a pool. You could agree to a big option pool that is awarded to people, and you could have a formula that you say, okay, like, I'm going to award people this equity based on X, Y, Z, and it could be pretty substantial. And another thing that, like, if your option price is really high and the new price is going to be lower, that's another consideration to keep in mind. Like, do you reissue options for people that have them at a high price? We did, and that was a very big benefit that people got from that process, where like they were sitting at a X price and that lower price than that for the option. By the way, like when you do a down round, your 401A valuation or 409A valuation ends up being much cheaper, because like inevitably that's a kind of a challenging situation. They're very comfortable with having a low 409A. So there's a lot of opportunity there as well in terms of benefits that the team gets.
Interesting. And just one more question on that, on the anti-dilution, asking your investors to waive that. Do you need all your investors to agree to waive that, or can it work?
Normally, yes. And I mean, look, the new investor is going to have some say in this as well, right? So even if your existing investors don't agree, the new investor has some leverage in terms of what to agree and what to not agree to. Some investors have a really hard time in investing. Like we didn't have to do this. So to be clear, like I've not lived through this, but I know that this happens, right? Where when investors are not able to get their companies to agree to, or their funds to agree to invest in a down round scenario, a new investor might come in and say, "Great, we will put a set of terms in here, which is pay for play, where like if you do not invest, you're going to lose all your preferences, right? And your shares are going to become just common. And so that's a mechanism that new shareholders might use to force older shareholders to kind of pony up more money and invest. It's a tough one. It's pretty aggressive to do. It really hurts seed investors in particular, because they oftentimes don't have the ability to invest more. But that's a leverage point that the new investors can use as well. That's a big reason why it's good to get alignment on, hey, all the old investors are going to invest X, Y, Z before you go out, and it's helpful from that perspective.
That's interesting. Any tips for messaging a down round to I guess employees, maybe?
Look, we have had a philosophy since Series A to not tell people what the price is. We did tell people what the price was on the Series A, and then I realized that's a mistake. as kind of time went by. And then I said, okay, we're never going to tell people what the price
why is it
going to be. Because these valuations are completely artificial. So valuation is for Series A, Series B, Series C companies. I'm not talking about like Series E company that's almost compared to a public company where the comp, right? I'm talking about these early stage businesses with very little metrics. The way valuations work isn't, hey, I convinced the investor that my valuation should be $50 million and they agreed, right? It's like, I convinced my investor to invest $10 million and then investor had a requirement that they own 20% of the company that led to a valuation of X, right?
Sure.
That's how these valuations come up.
Yeah.
And so it's totally artificial. I think it's completely unhelpful for people to think about, oh, I'm worth XYZ money because I raised money at this valuation.
Yeah.
And so I just think it's not helpful. And so we just don't talk about it.
Okay.
And so we have a very transparent culture. And so we did tell people we had a down round. We did tell people that it was challenging for these reasons. And then we were very direct in terms of what we were doing to address their ownership. And we were really, really big. And like, we tried to make up we try to get roughly 90% of our employees to own more of the company after the down round than they did before the down round. That was kind of the objective that we set. We couldn't do it for everybody because we had some very early employees that just owned so much that you couldn't make up for the whole thing. It was just not possible. Yeah. And so there we tried to do as much as we could, but it couldn't go all the way. But for anybody that we was, after that kind of the very first initial batch of kind of post-founder hires, right? We try to make up for them so that they would own more of the business after the down round than before. And our board and our investors were very supportive of that. And so the messaging was, look, it's a down round, but actually you own more of it. Now, valuations are totally artificial anyway, so it doesn't matter, but your ownership is better. And by the way, you can exercise a larger portion of your equity now with this new price because we repriced your old options as well.
Yeah, interesting. Good. This is really good tactical stuff, especially given the market. Any other just general thoughts, tips, advice you would give founders kind of as we're, in week 6 of shelter in place and who knows what this economy is doing? What are you telling people?
What I've been telling people and what we were doing as well is like cut anything and everything you can. So we went pretty deep in terms of like reductions that we could take place. Now we did not do layoffs. We had to do some furloughs, especially in an operational business, right? In the field team, because that's very tied directly to the volume that we're doing. We have had, since then we've actually been able to call people back because our volume is better than we had expected, which is awesome. I mean, like it was one of the hardest things to think about is like letting go or furloughing people who, making not that much money and really need a job right now. So it was really terrible, but I'm glad that we've been able to call people back as the business kind of got back into a better place. But we did do some furloughs and we still have some furloughs in place right now. But we mostly did a big salary cut. So we basically did a flat salary cut for every salaried employee at the company. We have hourly people for whom you can't do that, that's different. But for salaried employees, we went pretty steep there. We actually publicly said it was 25%. And so to me, that was a right move because we don't know how long this is going to last. And doing a layoff just didn't feel right at this time. And it also didn't feel necessary yet because who knows, maybe we'll recover in 2 months and then, we can get back to previous salary levels. And so my view was like conserving as much cash as possible is really, really critical in this environment. Getting as much of runway as possible is really, really critical. So things that we did, kind of the steps that we took, added about 4 months of runway to our runway, which I think was really important, right? And like if I could add more, I would. That's the most we could do, and then try to get as much capital in as possible. So whether that's venture debt or whatnot, if you have access to it and you can do it, you should. Now in our case, it's a little harder because we already have debt, so you can add debt to debt. But like, because we have a floor plan for buying cars, etc. But if you can get debt, you should. You might not like the terms. It might be really expensive on the interest rate perspective, but it's just valuable. And you might even think, I don't need it. Doesn't matter. Get the debt because you might need it. And so it's just better to have it versus not. And then thirdly, watch the market really carefully. Try to prove that you are resistant to what's going on as much as possible. And when markets open up, go and raise. I mean, VCs are taking a lot of meetings right now. Most VCs are not making decisions right now. They might tell you that they are, but they're really not. And the reality is that the bar is really, really high, like super high in terms of people investing. It makes sense, right? Like people don't know what this environment is going to be. And no one's feeling the pressure to go do a lot of deals. And I think it's really hard for people to invest in companies where they don't know the founders. And so, for better or for worse, founders that are known quantity will have a better chance here versus founders that are not. So going back to my point, like process of discovery, right? This is where you might really benefit, because somebody might have said to you and no in a Series A, but they at least got to know you in person, they got to know your team, etc. Now you might be able to go back to them and actually get a deal done over video, because they don't have a need to get to know you again. They already met you in person. Yeah. But it's really tough in the venture business to do deals over video, right? Because like getting to know the person and kind of get on both sides, on the founder side, on the VC side, it's really critical for you guys to know each other. And so it's a really tough environment. It's going to open up, obviously, but like the next few months are going to be really tough. I heard from one of my VC investors was like, look, we are telling our companies to have a year's worth of runway, which, intrinsically is what felt right to me as well, which is kind of what we try to achieve. And I think that's right. Like trying to have runway at least through Q1 of next year.
Yeah, that's good. Yeah, I was on a SaaStr virtual summit yesterday, and Mark Suster, who's at Upfront Ventures, was saying like, this is a great time to be reaching out to VCs because we're all stuck at home in our pajamas and hoodies, just doing video calls. Like, not that he was going to do a deal necessarily over video.
No, I think it's a great time to reach out to VCs, and they all want to see decks and they all want to talk to you, probably, because they have nothing to do. Although, they have a lot to do at the same time, because they're all doing a lot of portfolio management, right? Like, like who can I help, and what do they need? So it is very busy time, but yes, they want to see new companies. I just think getting a yes from a VC right now is really tough. Yeah. I think getting a yes on anything, I mean, a BD deal right now is really tough, right? Like we are talking to a few dealerships about like, do they come on our marketplace? And like, everyone's like, have a massive need, but like, can I think about that right now? Or do I think about the fact that I laid off 80% of my workforce? Like, it's just orders of magnitude different, right? And so I think getting anything done right now is really tough. It's just a bad environment, and there's nothing you can do about it. And it's going to be like this for a while. Yeah. By the way, I think people should be doing right now is renegotiating their leases. Landlords might not be happy me saying this, but like the reality is you have a lot of leverage here to renegotiate leases, and you should. In a good way, don't do anything rash and crazy. Don't not pay your rent for April or whatever, but go up there and have good conversations. I mean, I think the idea like don't pay rent, I don't think is smart, because it just creates a lot of complexity with the landlord. But the reality is that there's a lot of opportunity to renegotiate leases, and I think everyone should.
Yeah, interesting. Well, George, I've kept you a long time already, and this is really good stuff. Any just other tips, things, pieces of advice you would give your younger self if you were doing this all over again? Obviously, don't underestimate the operational challenges, but what else? Anything else?
No, I mean, I think that don't overvalue your business, right? Like being overvalued is a bad thing. I always said, don't maximize valuation, but even when you say that and do it, you still end up potentially being high. The reality is this is a binary. Startups are a binary business, and it's completely irrational, right? Like being a founder is a totally irrational phenomenon. And so because it's so binary, whether you're on 30% or 20% or 10% or 5% of a successful outcome doesn't actually matter. But, so don't worry about dilution. Focus on getting the right team, getting the right investors, and getting the right amount of money to do your job. And don't focus on dilution. Is kind of my view. And I've always believed that. I honestly believe that the next 2 years is going to be an amazing time to be a new founder of companies. We're going to see, not in the next 6 months, but like companies that are launched in Q1, Q2 of next year, and then onward from that for the next like few quarters are going to be some of the best companies we talk about in the next 10 years. Because recessions are when the great founders kind of come out of the woodwork and build great stuff. And so I think we're going to see some really great companies born in this time period. And, seed money is going to open up first, then Series A money is going to open up, et cetera. So like you kind of can match to that really good timing in terms of being a founder. And so I think like this is the time to be a founder. By the way, like think of all the opportunities this kind of situation is going to create, how many name brand businesses are going to fall apart in this environment, right? Because they won't be able to succeeding. So that's going to create opportunity as well. But I think it's a great time period to be a founder of a new company. Now, for those of us who are already in the thing, it's really tough. But like we're all dealing with crisis. I don't know of a founder who's not dealing with a crisis. Even business that are doing great still have a crisis because like they're not having so much usage. They're not used to that. E.g.
Yeah, right.
So it's like just a really tough time, and the world's not going to be the same for a long time period. I just that's kind of my view on that.
No, I agree with you. You see some of the startups. I made a list on LinkedIn of all the companies that were formed in 2008, 2009, and it's just astounding. Lots of mega decacorns. So.
Yep, that's normally that's always the case. So I think it's going to be a really interesting time period.
Very good. All right. If people want to learn more, it's simply shift.com. They can buy or sell a car there. Do you have any? You mentioned like the over 80,000 mile cars. Any like classic cars, or is it more new?
No classic cars. We try to limit us to like sub 12 years in age. We are very much like kind of your bread and butter car, right? Like we want to be able to serve a family living out in Oakland, buying their second car, their third car, or whatnot, or getting a bigger car because they have kids, etc. That's kind of our core business. We are not in the business of selling uber luxury cars. There's a company we have luxury cars, but that's not like our focus. There's a company called Vroom that is, online sales, and like literally like 90% of their inventory is 1 or 2 years old, and average sale price of $30,000. Our average sale price is $15,000. It kind of gives you a sense of like working in a very different type of a market. So I think it's just a different type of business, and we want to do we think that's the most interesting space to be in. That's where the demand is.
Cool. All right, George of shift.com, thank you so much. This is really interesting. Lots of good stuff. And stay safe, shelter in place, and catch you on the other side of this.
Likewise. I hope we open up soon here. That's my hope.
Yes.
Cool. Thank you very much. Yeah. Bye-bye.